Hello ladies and gentlemen, this is V, the system architect. In today's video, I want to talk about the correlation between stock market and political affiliation of the US presidents. So, I took the value of the SP 500 index for the past 40 years and I calculated the total return for each presidential term, and also I calculated the compound annual growth rate for a portfolio which is investing in SP 500 stocks. The last part of the video will be a review of the index-based portfolio versus a dividend growth portfolio. Now let's talk about the first president. Ronald Wilson Reagan, or Ronald Reagan, was the 40th president of the United States from 1981 to 1989. The SP 500 index was 135 at the beginning of his presidency and ended up with the SP 500 index of 277 at the end of 1988. Over his two terms, the economy saw a reduction of inflation from 12.5% to 4.4% and an average real GDP annual growth of 3.6%. Reagan enacted cuts in domestic discretionary spending, cut taxes, and increased military spending, which contributed to increased federal debt overall. From stock market perspective, the return during his first term was 23.2%, which corresponds of a compound annual growth rate of 5.35%. The second term was better. The overall market return was 66.11%, which translates in a compound annual growth rate of 13.53%. Overall, over his two terms, the return of SP 500 index was 104%, which is equivalent of a compound annual growth of 9.36%. I would like to mention one important event, and this event is the Black Monday, or the stock market crash of the October 19. On Black Monday, the Dow Jones Industrial fell 508 points, which is 2.26%, followed by crashes in the future exchanges and option markets. This was one of the largest one-day percentage drops in the history of Dow Jones Industrial. Significant selling created step price declines through the day, particularly during the last 90 minutes of the trading. The SP 500 index dropped 20.4%, falling from 282 to 225. The Nasdaq Composite lost only 11.3%, not because of restraint on the part of the seller, but because of the Nasdaq market system fail. Total trading volume was so large that the computer and communication systems in place at the time were overwhelmed, leaving orders unfulfilled for an hour or more. The next president that I want to talk about is George Herbert Walker Bush, which was the 41st president of United States from 1989 to 1993. The US economy has generally performed well since emerging from recession in the late 1982, but it slipped in a mild recession in the 1990s. The unemployment rate rose from 5.9% in 1989 to a high of 7.8% in the mid-1991. SP 500 index was 277 at the beginning of 1989 and 435 at the end of 1992. The return during the George Bush presidency was 56.89%, which translates in a compound annual growth rate of 11.92%. One event that it was mentioning that happened during the George Bush presidency was the Iraq War. At Bush's instance, on November 1990, the United Nations Security Council approved a resolution authorizing the use of force if Iraq did not withdraw from Kuwait by January 15, 1991. After the January 15 deadline passed without an Iraqi withdrawal from Kuwait, US and coalition forces began a bombing campaign at the end of March 3rd. A March 1991 Gallup poll showed that Bush had an approval rating of 89%, the highest presidential approval rating in the history of Gallup polling. The third president that I want to talk today is William Jefferson Clinton, or Bill Clinton, which was the 42nd president from 1993 to 2001. Clinton was president during the longest period of peacetime economic expansion in American history. From stock market perspective, the return during the first term was 70.01%, which translates in a compound annual growth rate of 14.19%. The second term was even better, with a return of 78.24%, which translates in a compound annual growth rate of 15.54%. Overall, over his two terms, the return on SP 500 index was 203%, which is equivalent of a compound annual growth of 14.86%. Now, we cannot talk about Bill Clinton presidency without mentioning the dot-com bubble or the dot-com boom, which was a bubble caused by excessive speculation of internet-related companies from 1995 to 2004. Many investors were eager to invest at any valuation in any dot-com company, especially if it had one of the internet-related prefixes or a dot-com suffix on its name. Venture capital was easy to raise, investment banks fueled speculation and encouraged investment in technology. Between 1995 and March 2000, the Nasdaq Composite stock market index rose by 400%. It reached a price-earning ratio of 200%. For example, in 1999, shares of Qualcomm rose in value more than 26 times. Even though the Nasdaq Composite rose 85% and SP 500 index rose 19.5% in 1999, more stocks fell in value than rose in value because the investors sold the stocks in slower growing companies to invest in internet stocks. To have an idea about how big the dot-com bubble was, for example, in January 31st, 1999, a total of 2 dot-com companies had purchased ad spots for Super Bowl 33. On January 30, 2000, almost 20% of the ads for Super Bowl 34 were purchased by the dot-com companies. In January 2001, just 3 dot-com companies bought advertising spots during the Super Bowl 35. The next president that I want to talk about is George Walker Bush, or George Bush, which was the 43rd president of the United States from 2001 to 2009. Bush took office during a period of economic recession in the wake of the bursting of the dot-com bubble. The terrorist attacks from 9/11 2001 also impacted the economy. His administration increased federal government spending from $1.7 trillion to $2.9 trillion, while revenue increased from $2 trillion to $2.5 trillion. Discretionary defense spending was increased by 107%, discretionary domestic spending was increased by 62%, Medicare spending by 131%, Social Security by 51%, and income security spending by 130%. To have an idea, cyclically adjusted, revenue rose by 35%, but spending increased by 65%. Between 2001 and 2008, GDP grew at an average annual rate of 2.1%. Unemployment originally rose from 4.2% on January 2001 to 6.3% on June 2003, but after that it dropped to 4.5% on July 2007. In December 2007, the United States entered the longest post-World War II recession, caused by a housing market correction, a subprime mortgage crisis, and increased oil prices. From stock market perspective, the return during the first term was minus 8.21%, which translates on a compound annual growth rate of minus 2.12%. The second term was even worse, with the return of minus 25.47%, which translates in a compound annual growth rate of minus 7.09. Overall, over his 2 terms, the return of SP 500 index was minus 31.59%, which is equivalent of a compound annual growth of minus 4.63%. The next president that we're going to talk today is Barack Hussein Obama, the 44th president of the United States, from 2009 to 2017. As you probably remember, on 2009, the Great Recession caused by the subprime mortgage crisis was at its peak. 2009 was the year when the US government had spent money like there is no tomorrow. $787 billion for an economic stimulus package, $2 trillion for buying depreciating real estate assets, and so on and so forth. For example, Obama intervened in the troubled automotive industry in March 2009, renewing loans for General Motors and Chrysler to continue operation while reorganizing. As it did to 2008, the unemployment rate rose in 2009, reaching a peak in October at 10% and averaging 10% in the fourth quarter. By November 2012, the unemployment rate fell to 7.7% and reached 4.7% by the end of 2016. Overall, during the Obama administration, the US total budget deficit ranged from $1.4 trillion to $500 billion. From stock market perspective, the return during the first term was 57.94%, which translates on a compound annual growth rate of 12.10%. The second term was similar with a return of 56.88% or a compound annual growth rate of 11.93%. Overall, over his two terms, the return of SP 500 index was 147%, which is equivalent of a compound annual growth of 12.02%. The last president I'm going to talk today is Donald John Trump, the 45th president of the United States. The period of economic expansion that began in June 2009 continued until February 2020, when the COVID-19 recession began. In December 2017, Trump signed tax legislation that permanently cut the corporate tax to 21%, lowered personal income tax rates until 2025, increased child tax credits, doubled the estate tax exemption to $11.2 million, and limited the state and local tax deduction to $10,000. Despite the campaign promise to eliminate the national debt in 8 years, Trump, as a president, has approved large increase in government spending as well as the 2017 tax cut. As a result, the American government budget deficit has increased to nearly $1 trillion in 2019. In 2016, the year before Trump took office, the US national debt was around $19 trillion, but by mid-2020 has increased to $26 trillion. The return until now during Trump's presidency is 45.20%, which translates in a compound annual growth rate of 9.77%. On the last chart, I put together all the SP 500 returns for each presidential term for the last 40 years. As you can notice, with the exception of George Bush terms, all the president has positive returns ranging from 23.2% for the first term of Ronald Reagan to 78.24% for the second term of Bill Clinton. In conclusion, from my point of view, doesn't matter what will be the affiliation of the next president, since both Republican and Democratic presidents have similar positive returns. Now let's take a look of what's the current status of the dividend growth portfolio and the index-based portfolio. As you can see here, the dividend growth portfolio as of today, November 2nd, 2020, has a negative return of 2.44%, but the index-based portfolio has a positive return of 16.52%. If we're taking a look on the index portfolio, we see that the QQQ, which is a Nasdaq 100% index ETF, still has the higher return of 33.08%, followed by the SP 500, which is a 10.86% increase for this year, and the Russell 2000 ETF, which has a return of 9.5%. If you want to see more videos like this one, please leave a comment below and don't forget to subscribe my channel. Once again, this is V and I'll see you next time.